Good afternoon, everyone. We're excited to have you on another Tax Tuesday webinar with myself, Clark Boyd, and Kathy Stump, who's joining me here today. Today, we're going to be talking about why year-end planning matters, as well as a few different tax deductions you should be taking advantage of, or at least know of. So, to give you a little introduction to who we are as a firm, Molen Associates is a tax preparation and accounting firm located in the greater Houston area. We've been in business at this point for 45 years. So we specialize in self-employed individuals, small businesses, and we do everything from bookkeeping to tax preparation, tax planning, IRS representation. So we're kind of your one-stop shop for your business and accounting needs. The purpose of the webinar is really to help you become in control of how much you're spending in taxes. Everyone is legally obligated to pay taxes, but that doesn't mean you need to pay more than your fair share. So let's use these as legal loopholes to reduce your tax liability and save money so you can reinvest into what matters to you, whether it's travel, retirement, you name it, put the money there, don't give it to the government. We want to keep that as low as possible. So we want you to understand how the tax code should work, how it can work for you, not against you. So we want you to be in control of your tax situation. With that being said, year end is a very, very critical time when it comes to tax planning. So if you look down here, I've got this little bar graph. It's pretty rudimentary, but I think it portrays the point. December 31st is a hard stop. So you've got your tax planning window, which is right now, and then tax reporting until April 15th. Obviously, you can file an extension, file later in the year. But the point I'm trying to make here is there is a planning period and a preparation period, or a reporting period. Once December 31st happens, there's not a lot you can do to change your tax situation. Sure, you can make retirement contributions. There's a couple of things, but in all honesty, a lot of what we're going to talk about today and in most of these webinars, it requires a little bit of planning and preparation, even if it's just calculations to determine, is this worth it or not? Does this make sense in my situation? If so, how much work is it going to take? How much time versus the tax savings? Because sometimes maybe it's going to take 2 to 3 hours to do, and it's going to save you $100. Okay, maybe that's worth it, maybe it's not. But someone else in your same situation, maybe it's 2 or 3 hours to set up, and it will save them $20,000 in taxes. If you tell me 2 to 3 hours, you save me $20,000, I'm in. So $100, maybe on the fence. But everyone's at a different stage of their income, their business, so you have different needs and wants. But just remember, December 31st is a hard stop for a lot of these. You can't catch up later. So charitable contributions, setting up payroll, things like that, it really is a December 31st hard stop, which means we've got about 2 weeks before the end of the year. So if you're looking to get in with us, you've got about a week and a half before we are no longer taking consultations. We're out of the office, working more behind the scenes. So the first strategy we want to dig into is Roth conversions. This is a super big one. I'm going to turn the time over to Kathy and let her explain a little bit about this.
Roth conversions are basically taking money that you've already invested in a tax deferred account like an IRA or 401k. You can make contribution or conversions of that money over to a Roth. When you do that, though, a Roth is based on after-tax dollars. So when you take money out and put it into a Roth, if you take it out of your tax-deferred account, you do have to pay income tax on that. There are reasons to do that, though. If you have a year that you've got much lower income and you're in a lower tax bracket, it makes sense to go ahead and do that Roth conversion in that year. Because the benefit of the Roth, even though you have to pay tax on the initial amount right up front, if you do a Roth contribution, just normal Roth contribution, you do it after, you don't get a tax deduction for that. You pay it with after-tax dollars. But the benefit to you, number one, you're investing in your retirement plan. But after you have had the money in the account for 5 years is the minimum, you can take that money out. And the money that you take out from the actual contribution or conversion, of course, would not be taxable to you because you've already paid tax on it. But the bonus is that you also would not have to pay tax on any earnings. So the longer that you've had money in the Roth and it's sitting there earning money, that it's actually earning tax-free money for you. So that's always a good item to have in your little buckets when you get ready to retire. It also has some benefits for, if you're doing RMD planning, if you're talking about IRMA, which is the Medicare tax payment that you would be required to pay. And then if you also have the belief, as a lot of people do, and it's proven itself to be true over the years, that taxes are going to be higher in the future. So let's start making some contributions into a fund that's going to be tax-free when you take money out. You can contribute too much or convert too much to a Roth. It can affect things like the IRMA calculation, student loan repayments, if you happen to still have those. It can also put you into a higher tax bracket, so you really want to be aware of what you're doing so that you're not paying tax on the Roth conversion into a higher bracket. It can also affect some of the phase-out limits, like the $6,000 senior deduction, for example, has a limit on that, and if you make over that amount, then that deduction goes away.
Perfect. So like Kathy said, there's a lot that goes into determining if you should do a Roth conversion or not, because there's so many factors. To put it simply, do you think you'll be in a higher tax bracket later or a lower tax bracket later? If you think it'll be higher, do more Roth conversions now. If you think it'll be lower, don't do it. Maybe you want to do a traditional IRA contribution. So there's no right or wrong answer, but to show how some of these work together, we put together some math. So we're just going to take you through an example situation. In this situation, we've got two clients, John and Sarah. They're married, filing joint, age 62. So not quite at retirement age, but getting close there. So they're trying to do some preparation. And the reason I say this is 2 years before retirement, IRMAs, IRMAA, that basically those 2 years before retirement, you need to start thinking about Medicare planning. So you don't want to be bringing your income up too high, or else you're not only increasing your taxes, you're increasing your Medicare premiums. So this all kind of comes together. These ones specifically are a business owner. Maybe they're stepping back, they're winding down the business, but they just had overall lower profit year, lower income. So it's a one-time lower income year, and they got some cash on hand. Maybe it's from a prior year, or current year, whatever the case may be. They've got a decent-sized traditional IRA, and their Roth IRA looks like it's newer, has some money in it, but they do not have any RMDs yet. Those will start at 73. So summarizing their sources of income, and this is just 2024. I put two different examples in here, both are from 24, just for clarity's sake. So their business income, or W-2 combined, is $85,000. They had $5,000 of interest and dividends. So total gross income, that's what they're basically what they would be paying taxes on. So minus a standard deduction of $29,000 leaves a taxable income of $61,000. So with the way tax brackets work, it's a stepping stone. You take out the standard deduction, you don't pay taxes on that. You then go into the 10% bracket, 12%, so on and so forth. So they are marginally in the 12% tax bracket, but they have $33,000 of extra room. So for example, if they were to go from 61 to 94, that's the top of that 12% bracket. So if they convert an additional $33,000 and max out that 12% bracket, they'll pay $3,960 in taxes to convert from the traditional IRA to the Roth IRA. That allows that balance now in the Roth IRA to grow tax-free forever. So it's a one-time tax payment, still at the 12%. So if in this situation, if they were to convert 100,000, or if they were to convert more than that 94,000 level, for example, 33 more than that, it would go into the next tax bracket, and that would cause an additional jump in taxes. So depending on what they think their income will be in retirement, that may or may not be wise. But generally the 12% tax bracket is pretty low. It's a good one to convert into. So if they don't convert, so this is if they do versus they don't. If they don't convert, it'll stay in the traditional IRA. Funds will keep growing. They'll be required to take RMDs, required minimum distributions, at age 73, which means that their tax brackets later on will likely be higher, and their IRMA, their Medicare surcharges, will also likely be higher because their taxable income will be higher. So those brackets and those surcharges are annualized. Basically, they're published every year, indexed based on inflation. So I couldn't tell you what they're going to be 10 years from now. Congress may change, those brackets may change, inflation may change, but as Kathy mentioned, generally speaking, the tax brackets as well as the tax rates we can assume will be higher in them. So if they do convert, that will lower future RMDs because they will have less in that traditional IRA account. More will be in the Roth IRA. That's also good if you want more control over your money. Like it, next one right here, more control over taxable income. You have lower Medicare premiums and tax-free income later. So those are all good things. So there's a lot of text on one screen, so I'm going to walk you through a little bit of it here. So what happens if they convert 100,000 instead of the $33,000 we talked about? So if the first 33,000 is taxed at 12%, but that remaining 67,000 would be taxed at 22%. So essentially, they increase their taxes on that 67 by 10% over what they could have. So this is not wise for them if they think they're going to be back in the 12% tax bracket for future years, because they just increase their taxes unnecessarily. In all honesty, if you're talking $1,000 if you miss that window by just a little bit, it's not the end of the world, but you do want to do this math so you know where your taxable income is going to come in at. Like I said, it pushes them into the 12% tax bracket. Your MAGI increases, which is modified adjusted gross income. This may also impact your deductions and credits. So for example, in 2025, with the One Big Beautiful Bill, they introduced the $6,000 senior tax deduction. So if you're below a certain threshold, if you're married filing single or married filing joint, or just single, you have up till that threshold of income where you qualify for this income deduction. If you're above that threshold, it starts to phase out to a point where you don't actually get it. So you need to watch that while you're doing these Roth conversions. So maybe you need to stay below a certain, it's not just tax brackets, there's deductions and credits for you as well. If you have loans, especially student loan repayments, a lot of those are indexed based on your income levels. So if your income goes up, your student loan repayment may also go up. So that may not be wise. So make sure you don't create a tax spike by over converting. Like I said, higher tax rate, increased IRMA risk, you got phase outs and deductions, and just poor planning in general can cause detriments to your taxes. So Roth conversions can be good, doesn't mean they always are. This is a little bit more detail on the IRMA. I won't go more into that. But for example, in 2025, that initial IRMA bump, I think is at $212,000 for married filing joint. So in this situation, if you convert too much, and you go over $212,000, you're talking a few $100s more in Medicare premiums monthly. So it's a pretty big jump if you do it incorrectly. So the best Roth conversion is not the biggest one, it is the most intentional one. I put that quote at the top here because I think that's the moral of the story with Roth conversions. Be intentional, do your math, do it twice, and triple check it. Like I said, tax planning versus preparation, we can only do so much on the preparation side. If you over converted or under converted, we can't do a whole lot on the backside to fix that. So don't convert everything. Don't try to avoid all taxes. You want to be in control of what tax rate you're at, how much you're paying in taxes, and avoid any unintentional consequences. So this is definitely something you'd want to meet with your tax advisor on. If you have cash in your traditional account and you want to start making those conversions, whether you're nearing retirement age or even if you're younger, you just want to switch those tax funds over, I don't want to say there's a right or wrong, but there is math that can drive your decisions. So hopefully that helps. If you don't want to take over family payroll strategies?
Sure. Family payroll applies if you've got a business. It can be a Schedule C, it can be a S corporation. Age considerations for children. If you're paying children on your payroll, you have to make sure, it has to be a child that can contribute in some way to the business. It has to be a real job. We've seen kids as young as 3 or 4 qualify in certain situations where they are kind of the face of the company. They're participating in advertising campaigns, that sort of thing, if you're okay with your child's portrait being out there, those kind of things. And as they get older, they can do more things in your business. Some things like, stuffing envelopes, doing, cleaning around the office, tidying up. As they get older and understand more about your business, they can answer the phone for you. They can do some filing for you. They can do website development. As we all know, some of the kids do better at stuff like that than mom and dad do. So anything that they can do age appropriate, it's definitely worth paying your children through the business. There's a lot of reasons for it from a standpoint of, the child's perspective. You don't really want to just give them that money and let them go spend it all. They could spend a certain portion or whatever your family idea of them spending money is. But the big benefit of it is being able to, fund an IRA for them that also makes them have, number one, it's setting them up with a good example. Can you imagine if you can already tell a 10 or 12-year-old or a 15-year-old that they already have this account set up, mom and dad worked hard for this and set this up so that you have this foundation for your future. And it just gives them a good, it's a good teaching lesson, but it also gives them a good start in life to have that to kind of fall back on.
Sorry, I just unshared. Let me share that again. There we go. I meant to hit unmute. Thank you, Kathy.
No problem.
Yeah, family payroll is huge. We got one more example here. For the rest of these topics, we won't go through quite as much detail, but these are fairly unique situations where the devil's in the details. So you want to make sure we get it right. I failed to mention in the beginning, if you have any questions, feel free to put them in the chat. There's a Q&A tab. You can ask any questions there. If we see them as we're going through, we'll try to answer them. If not, we'll open it up for Q&A at the end. So the example for paying a child through a Schedule C. So we'll do a Schedule C. As Kathy mentioned, you can do it as a Schedule C as well as an S Corp. The rules are a little bit different. So in this situation, this will be a sole proprietor filing as a Schedule C. This could be someone, maybe it's a small business. Maybe they could be doing work and receiving 1099 income from some sort of employer. Really, the type of company does not matter. It's really how it's filed. So we'll say their marginal federal income tax rate is 22%, just for the sake of math, and self-employment tax does apply. So anyone who's unfamiliar with the Schedule C, you have your federal income tax rate plus your self-employment tax rate, 15.3%, and that applies to any business profits. So a lot of times we'll recommend moving over to an S corporation to minimize that self-employment tax. And really, self-employment tax and FICA are almost opposite ends of the same coin. It's the same percentages, really the same purpose, just calculated for different purposes. So if this is the parent, 22% plus 15.3%, you're talking 37.3% income on any business profits. That's pretty high. So there's definitely ways to lower that. If the child is 16, they're old enough they can do legitimate work. So a couple examples of this are, like Kathy mentioned, admin, marketing, filing, cleaning, whatever it may be. Just make sure it's age appropriate and it is legitimate work. So whether you charge them hourly, pay them salary, just have some sort of job description. What are they actually doing in your business to substantiate this? This is not a let's commit fraud with the IRS to save some tax dollars. This is a legitimate tax strategy. If used correctly, it can be super helpful. So step one, you want to define the work and pay. So it needs to be reasonable and legitimate. So if I have a 3-year-old and I'm saying she's going to be doing website design for me, 3-year-old is not going to be doing web design. As Kathy mentioned, maybe they're acting as a model. They're the face of the company. Okay, there may be some reasonableness to that. So make sure it's a reasonable rate, reasonable hours. You can't, just because they're your child doesn't mean you can pay them $100,000 if you've got someone else doing the same job for $10 an hour. It needs to be somewhat reasonable. So let's say this person's getting paid $15 an hour for 20 hours a week. They're in high school, so that's pretty reasonable. And they will work 40 weeks of the year. They've got some time off. They've got finals and Christmas, whatever it is, 40 weeks of the year. So that annual calculation comes to $12,000 in total wages for the year. So it's reasonable, it's age-appropriate work, and it's legitimate business purpose. So we got those 3 checks. Step 2. So because this is a Schedule C and the child is under 18, they not only pay they don't pay federal taxes, they also don't pay payroll taxes, FICA. FICA is a 4-letter F word. We want to avoid it whenever possible. So no Social Security, no Medicare, no FUTA. So that is super helpful. If you're to pay as an S Corp owner, this is different. They do have to pay FICA. So there is some tax, even though they won't have federal income tax that applies. So just note that as one thing that's different. Even if you're paying your child and they're over 18, they do not get this payroll tax exemption. That's only 18 and under from a Schedule C. So step 3, we're going to go over what the tax impact is to the employer or to the parent. So if you're at the 22% tax bracket, you get to take a deduction for the $12,000 you're paying to your child. That is fully deductible to the business. You're moving from not only a 22% tax bracket, but 15.3. So on that $12,000, you're saving $4,400 of taxes. So that's huge. That's a huge amount of money on a fairly small amount of salary in comparison to the grand scheme of things. So step 4, how does this, you take the income deduction on your side, but what does it look like for the kid? So the kid now has to claim a W-2 wage of $12,000, but we already avoided payroll taxes because we set it up correctly. They get a standard deduction. And once again, like I said, this is 2024 numbers. The numbers are higher for the standard deduction in 2025, but because the wages are under that standard deduction, they pay 0 in federal income tax. So taxable income is 0, federal income tax is 0, which they pay no payroll tax, no income tax, but they still have earned income because they had a W-2, which allows them to do a Roth IRA. So as a parent, you can also do a Roth IRA. If you're working or your spouse is working, you can each do a Roth IRA, contribute your own money to, you pay taxes on it, and then contribute. The nice thing about doing it for a child is we just saw 0 income tax. They have officially paid taxes on it. Even though it was 0, taxes are cleared. So now you can fund it up to that annual's limit. So every year the limits are increasing. It's indexed with inflation once again. So look at what the limits are for whatever year you plan on enacting this. But you're limited to the lesser of the earned income or the Roth IRA limit. So if you earn $12,000 and let's say you put in $7,000, they're left with $5,000 cash, but now they have $7,000 in this Roth IRA. They can fund retirement. I think I've got that right here. How can the money be used? It can be used for education, for their first car, a down payment on a home. Ideally, they can leave as much in as possible for retirement. That's the long-term best strategy. But going through what this could look like long-term, let's say you start at 13, you do it for 13, 14, 15, 16, and 17. 5 years total, they're working in your business. And just for flat numbers, let's say you contribute $6,500 into the Roth IRA, and the rest of the money they can spend. They can do whatever they want with. Investment returns, we'll say a nice conservative 7%. There's no additional funding after age 17. What happens from age 17 to age 65? It all grows tax-free. You contribute a total of $32,500. By age 65, they're almost a millionaire. So you've set them up very, very successfully for retirement. And that's if they never put a dime in again, they don't touch it. That's a huge amount of growth. Obviously, this type of growth, it's all about what type of interest rate can you get and how long you're in the market. If they want to do other savings with that additional $5,000 that they haven't put in the Roth IRA, they can do a brokerage account. They can do other things too, but this is just that Roth IRA funds. So a lot of parents say they want to put their kids on payroll, but don't just stop at payroll. Payroll and Roth IRA. Huge, huge, huge. So just kind of doing a recap here. Keep a job description, keep timesheets. Make sure you do a W-2, not a 1099. We talked about the parent having federal tax and self-employment. You don't want to take it from your income tax and make them pay self-employment tax on it as well. It still may be a tax savings for you, but there's a better way. So keep it on a W-2. Make sure it's reasonable and make sure you have payroll set up before year end. Like I said, there's a planning and preparation period and there's a reporting period. This needs to be done in that planning period before the year is over. A couple mistakes we've seen that you should avoid. Make sure you have this documented and your document really falls into these categories here. Make sure you don't overpay for minimal work. Don't pay them as a 1099 and don't try to do payroll in the new year. So, and then another one, parents also assume, oh, I'm an S Corp, I can pay my child. The rules are different. So it's a little bit of a different setup. The tax calculation is different. So talk with the tax advisor. And once again, this is a tax strategy, not a loophole. So loopholes are okay to use if you do them correctly, but it really should be a legitimate strategy. I haven't seen any questions on that, so we'll keep going. Kathy, do you want to take tax loss harvesting in these next couple?
Sure. Tax loss harvesting is a strategy used if you have just a traditional investment account, or if you own stock in, just outright own stock in a company. Basically, you can look at that, and sometimes you look at them and you purchase them thinking that they're going to be, growth. You want that growth, or they pay dividends, or, there's a reason for it. But it doesn't always work out that way. Sometimes you look at them and say, something happened in that market or something happened in that industry, or they're just not running their business well, and they're continuing to, rack up losses. Their stock prices went down. They've stopped paying dividends. There's many reasons to look at that. And if you're looking at those and think, well, maybe they're going to turn it around, and, you don't really want to just give up on it. But the time that you do, if you've already made that determination that they don't look like they're going in a good direction, or you just think you've been in it long enough and it's time to diversify out into something else, you can look at that in years. Like, for example, say that you've got one account that's got large losses in it, or and you've got another one that has capital gains, and you want to have some of those capital gains offset by your capital losses. And this is a good time to make sure that happens. And again, this is another thing that has to be done before year end. The sale would have to be gone completely through before you'd be able to take that against your 25 tax return. It also makes, it reduces ordinary income up to your limits, of course, and you can carry it forward to future years. If you have one that you just realize is just not doing well at all and you don't expect for it to turn around, you can carry it forward to future years. And it's another one of those things that just gives you that opportunity to plan. You're looking at this and saying, well, at some point I'm going to have to just give this one up. I might as well do it in a year that I've got gains that it can help me offset. Always make sure that you're avoiding wash sale rules, though. And wash sale rules mean if you buy something back that you just sold within a certain amount of days, you just need to be really careful. If you're going to give up something that you feel like you're giving it up because it's the things I mentioned, it's market shares going down, dividends are not be paid, those kind of things, unless you feel like, okay, it's going to turn back around and you want to go back out and buy it again, so you can say, well, okay, now I've got a lower basis in it, it'll be okay. Just make sure that you give yourself enough time to avoid the wash sale rules in that. And also make sure that you always coordinate this with Roth conversions, any portfolio rebalancing. Depending on if you're managing your account yourself or you have a broker that's managing it for you, you want to make sure that you talk about that with them, because sometimes they have strategies for year end. It's like they might already have something in place that you might not be aware of. So make sure that you consider that and talk it over with your broker if you have a broker managed account. Also, if you've got other assets that's being sold in this year, or if you've got just an unexpected year-end bonus, your company that you work for is doing really well and you got an unexpected bonus, that's a good time to consider these strategies as well. In retirement and charitable giving, and we think of charitable giving a lot of times as just the amount that you pay to your church or your two other charities that you're involved with and are passionate about. You can, take an itemized deduction for that. But there are other ways that you can do that as well. Business owners can make contributions into retirement accounts, of course, but those charitable giving strategies can also play into your retirement accounts. You can make a distribution when you get to RMD age out of your retirement account that would qualify for your RMD, but also give you a tax deduction in the current year. The other thing that you might want to consider is when you're giving charitable contributions, it's always the typical, just write a check or have it taken out of your bank account, whatever you're doing. But if you've got appreciated stock, crypto is another one. If you've got those kind of assets anyway, and you're looking at them like, I really want to make this contribution to my church or my favorite charity, and you have those appreciated stocks, and it's okay, well, if I sell those, I'm going to have to pay capital gains on them. You can donate appreciated stock directly to the charity and take that deduction for the value of the stock that you're donating. And you, in that case, you would avoid the capital gain tax on it. So if you have appreciated stock, you can donate those items to churches or charities, anything that's a 501c3, and take that deduction without paying the capital gains on the growth. Donor advised funds are a more advanced strategy, usually used with larger taxpayers. It's a good retirement or like estate planning type strategy. Basically, you set up a fund and you put in whatever you want your contribution to be. Say it can be $200,000. And you don't have to sit and decide, okay, I've got $200,000 to give. I want to give this much to this charity, this much to this charity. You have time then to plan, but you get the deduction when you set up the fund. So that's a good long-term strategy, some kind of legacy building type things. The other thing you can think about too with charitable contributions is one of the ones that you have more control over. So if you look at that and say, okay, I just never quite hit the limit because the standard deduction's gone up so much over the years that a lot of people just don't ever really quite hit it. But especially if you're getting close and you do normal contributions throughout the year, you can bunch those together in 1 year. So at least 1 year you would get benefit from it. Just for example, if you normally pay or contribute $2,500 a month to your church, and it doesn't quite get you over that. If you do that contribution at the beginning of the year and then do another one at the end of the year, because keep in mind you're tied to a calendar year as a individual taxpayer. You can make one big contribution in January and then another one in December, and have that contribution enough that you would go over and get some benefit from the itemized deductions. This gives you opportunity to align your intention, like if you're passionate about either your church or some other charity, that gives you a chance to align that with tax efficiency. Mistakes to avoid, of course, donating cash when appreciated assets are available and would be better. Missing substantiation requirements. You always want to make sure that you have a receipt. Canceled checks are good. Bank records are good. Larger items can sometimes require appraisals to make sure that you're, especially if you're donating appreciated stock, you would want to, if it's not traded on the market, that you can have, okay, I donated on this day, it was worth X. If it's private company stock, you might have to get a valuation of the company to be able to substantiate that. Those requirements are only if you're audited, of course, but your tax preparer may question if you're doing something unusual for you. And then also waiting too late to fund them. If you kind of think, oh, my intention is to do this, and it's like, oh, I forgot, it's January the 1st. And basically then you've just made a deduction for the next year when you do that. And business owner specific year-end moves. These are, if you have a business, sometimes it's always tempting to think that they're not necessarily tied to a calendar year, and they cannot be tied to a calendar year. If they have a fiscal year end or if they're on the accrual basis, they've got different rules. But if you have a business that's based, a cash-based business, and you're looking at year end and it's like, oh, my planning got away from you and I am now looking at a larger tax bill that I had anticipated. You've got this short period of time, once you realize that you can do some things like accelerating expenses or deferring income. Accelerating expenses is probably a little bit easier because if you're deferring income, basically you're going to have to see if some of your invoices coming in, or maybe you don't bill in time for them to pay you before the end of year would be examples of deferring income. But if you look at things that you're going to buy for your business anyway, that, a big one that I see sometimes is people will do all their office supplies type thing. If you've got equipment that you're going to need, we always say that we don't ever recommend you going out and buying something just for the tax deduction. But if you know that you're going to need a new computer, you know that you're going to need a new copy machine, you know you're going to need a new vehicle, those are the kind of things that you can think about and think, oh, I'm at the end of the year, but it still counts as an expense as long as it's 100% business usage and you paid for it and got it placed in service before year end. Those are kind of the criteria, making sure that you do have it placed in service. You can't have something on order. You can't have something that's got a delayed installation. It does have to be placed in service. The biggest thing I think that you can do with that too, on cleaning up your books, it's tempting to kind of put that off and think, oh, well, I don't need that until tax time. I'll just kind of let it roll through. Really, your books are more than just for your tax return. They're how you run your business and how it gives you the idea of how you're doing. Am I doing okay? Did I make a mistake here? Could I have done better on this area? Those kind of things. And you really don't know that. You might have a gut feeling for some of those, but your books is what tells you the whole story. And they're very important. It's not something that's like, oh, it's tax time, I've got to do this thing. You really need to do this throughout the year so that you know kind of as you're going along, and that way it'll avoid year-end tax surprises. It's like, oh, I didn't realize I made this much money. Oh, what happened? I'm in a huge loss.
And we see that so often. And we get to the November, December, they're like, oh, yeah, I'm doing good. It's been about the same as last year. And they had a $100,000 increase in profitability. They just didn't realize it. So staying on top of your books throughout the year is huge. Because if you're $100,000 up, that means you really need to do some planning to bring your profitability or taxable income down through different strategies.
And especially if you delay that until, we've been talking about and harping about the December 31st, but that is a hard stop. If you look at that at the end of the year, it's like, oh, wow, I didn't realize that I made $100,000 extra, that more than I was anticipating. And if you wait until tax time when you're sitting with your accountant, either March 15th or April 15th, and trying to decide, it's like, oh my gosh, what happened? What can I do? Well, there's not a lot that you can do at that point. And then also it kind of cramps your style. I mean, by that point, you're already 3 months into the next year. And you've not planned for that either. You've got, okay, did this impact my first quarter? Did this, if you're on extension, did this impact the 3 months or 3 quarters of the year that I've been not paying attention to my books? It is really, really important. Reasonable compensation for S corporation owners. S corporation owners have some significant tax savings, mostly based around employer taxes. But there's requirements that go with it. And you can't just say, oh, I'm going to be an S corporation and take all these benefits. You do have to have what they call a reasonable compensation for your contributions to the business. And that's become more of a kind of a little bit of a red flag for the IRS if you have an S corporation and you're, kind of reaping all these rewards, but you're not taking any reasonable compensation, which means you're not on payroll. Distributions don't count as reasonable compensation. It has to be W-2 wages, just like a normal employee. Now, speaking of those, if you're looking at your business and it's like, is my business really structured tax efficiency being not number one, but one of the high ones? If you have a Schedule C business and you're having a profit year over year, and you notice that number on there that's telling you how much you're paying into FICA, which is 941 taxes. You're paying that in based on your net earnings of your business, where if you transfer that over you convert this Schedule C that you've had into an S corporation, you do have that payroll responsibility. You do have to run payroll in an S corporation, but the savings on payroll taxes can be pretty significant. The other thing you want to always consider too, qualified business income deduction is a deduction that's basically just a free deduction. You don't really have to do anything for it other than just be in business. It's kind of a stimulation of the economy type thing. It's been around for a long time. It was scheduled to drop off at the end of this year. It was a cliff. It was going to go away. It was resurrected with the One Big Beautiful Bill and is also now a permanent deduction. So you really need to think about that as you're doing your calculations of everything. If you drive your income down too much in preparation for trying to get taxes low, then you also reduce your QBI because it's based on your profit. And if, it's kind of one of those balancing acts that you need to consider.
I will add a plug on this slide because you mentioned the QBI as well as a few other things here like Section 179, bonus depreciation. If you have not watched one of our webinars on the One Big Beautiful Bill, I would highly recommend it because that is, if you're a business owner or even if you're not, there's so many changes to the tax code starting with 2025 that you need to be aware of. So if you just go to our YouTube channel, look at the recent videos, they're all listed there. You can go to our blogs and search through the blog history, and there's a ton of information there. But the One Big Beautiful Bill is a huge one that everyone not only needs to be aware of, but really be educated on.
Definitely. Okay, household and income planning considerations. Some of these things you don't have control over, but it's important to realize when you do have control. Like if you have control over when your bonus is paid and you want to know, well, am I going to be in a higher tax bracket next year, or possibly this was a low income year. If I could put it in this year, it would be a better for me from a tax standpoint. And sometimes even employers are willing to listen to those kind of things if they don't have a business reason to not do that. It never hurts to ask if you can, can my pay bonus be on the first payroll of the year rather than the last payroll of this current year. It just kind of it gives you some control over your income levels. And as we've talked about other things, there's a lot of things that are dependent on income levels, and some of the credits are dependent on income levels. Tax brackets are the biggest one, of course, and very dependent on income levels. The capital gain timing on property or stock sales, if you look at those kind of things and you realize that in February, it's like, oh, well, this stock's not doing great. What happened? Then you're into a tax planning opportunity for the next year, but you can't bring that back into the current year once you get past December 31st. Education credits and phase outs, if you've got a child in school that is, that you have been enjoying the tax credits, you kind of need to keep an eye on that because there are income limits for that as well. And also a planning opportunity that you just need to kind of be aware of it when they get past the time, even if they might be in school an extra year, some of those are limited to only 4 years of the credit. HSA contributions and investment strategies. HSA contributions are a really good opportunity to save money. It's a before tax deduction either from your paycheck or if you make contributions directly to an HSA. You can have that money available for basically tax-free doctor's visits, medicine, those kind of things in a health savings account. Or you can defer, you can let it grow. And a lot of people put the maximum in every year. And it's always a wise strategy when you're healthy. And you just think, sometimes you might be thinking, oh, well, I'm healthy, I don't really need that. But you can let that grow to future years when you may not have health insurance after you retire, or you may have health concerns that are coming up. It saves you on income tax there. And then also a year-end check of your income. I was like, sometimes you don't realize
that one.
I'm sorry?
Can I add something on HSA?
Sure.
So not only contribute to your HSA, but make sure it's invested. So we've done so many times where we've seen an HSA and it's just sitting in cash and they've contributed to it for 5 or 6 years. It's not growing. So you get to take the payroll deduction, it grows tax-free, and you get to take the tax deduction for those medical benefits. So make sure you're actually getting some growth on that account. Otherwise, you're missing half the benefits. So we see a lot.
And then I think a lot of people do consider this. They look at it at the end of the year and think, oh, well, I'm in a 25%, 27%, 30% tax bracket, and my paycheck is only withholding 10%. Sometimes they get all the way to their tax appointment and have not really done the math on looking at that. They don't, their check. I think we see this more commonly now that more and more paychecks are direct deposited. You don't really see an actual paycheck stub unless you go looking for it. But that's an important thing to look at, just to make sure that they're withholding at the correct percentage. There could have been a mistake in the way you filled out your forms, telling them what to withhold. It could be a mistake on their part that they're just not doing it correctly. But it's another one of those things. Once you get past the end of the year, then you're stuck in that thing. Well, why do I have to pay estimated tax payments? Because you didn't have enough taken out of your paycheck. And there are no penalties. If you have enough paid in through the payroll withholding for your tax liability, then it doesn't count toward that penalty for underpayment of estimates. You can take your whole paycheck, and we've seen clients do this. They'll take their last 2 or 3, they'll get to the end of the year and realize that they're severely under withheld. And you have that opportunity to go to your payroll provider and say, oh, take all my money, and finances allow you to do that. Take all my money and apply it to my federal withholding liability. It goes into the federal withholding on their FICA forms, and you can see that on your W-2, and the IRS doesn't care that you did it all the last month of the year. They consider it done evenly over years. So it's really important to look at that. And then if you're not going to be able to do that, are you going to need to make an estimate? Do you need to pay something in so that you do minimize that? Especially if you know that there's something that's going to happen that's going to require you to be on extension. There's going to be forms that you're not going to have, or you're just not ready with your business, or whatever's going to put you on extension. You do need to make sure that you're aware of the filing requirements to get estimated tax payments in, and also not to forget that you also have payments that will be due for your coming up year too. So a lot of people think, oh, okay, I finally made it. I've squeaked through. I've made my tax payments for this year, and they're behind on paying tax payments for estimated payments for the following year.
Perfect, thank you. So Kathy's gonna have to step out and do a quick signature real quick. So I'm gonna take these next couple of slides. So what not to do at year end. Don't do a Roth conversion blindly. Don't buy equipment just for a tax deduction. Like Kathy said, we always want tax deductions, but don't spend the money just because you need a tax deduction, because you're still having to spend money to take a deduction. You also don't want to over contribute to retirement accounts. That is one of the hardest things to unravel, is if you've over contributed to a retirement account, we have to undo it. Also, don't rely on the internet hacks without context. So TikTok is not your tax advisor. You may get good ideas from TikTok. That doesn't mean they're legal, doesn't mean they're right, doesn't mean that they apply to you, doesn't mean that that person understands the due diligence. 3/4 of what's out there is probably incorrect, even if it is tied back to good, solid advice. So those are what not to do. So here's a much longer checklist of a few of the things we've covered, a few of the things we haven't. As I mentioned, we do these webinars once a month outside of tax season, and during tax season, we're actually doing them weekly. So last month we did one on charitable contributions and year-end donations. This one's just kind of on year-end in general. Our next one is going to be January. Let me pull it up here. So here's the page. So if you go to molentax.com/webinars, you can see our list here. So the next one will be on January 20th at noon. We're going to see getting ahead of tax filing season, how to stay ahead of the mistakes. So some of it will be what documents you need, one big beautiful bill changes, common filing mistakes, what you can do proactively during tax season. But look at this checklist here. There's a lot here that if you just go through this, and this is not all inclusive, this is not very comprehensive, but this is just a lot of the things we've been helping business owners and individuals out in the last 30 to 60 days, kind of through that year end. So we've got Roth conversions, family payroll, unrealized gains or losses, retirement accounts, itemized even standard deduction. That's a new change with the one big beautiful bill. There was changes with the SALT tax. You may itemize if you've done the standard deduction in the past. So that changes a few of your strategies. Bonus depreciation in section 179. That's also from the one big beautiful bill. So I won't go through each of these individually, but there's a lot here that you can take advantage of. So feel free to screenshot it. If you register for the webinar, you'll actually get a copy of the recording. So that will be live sometime later today. But going into a couple questions. I saw a couple questions come into the chat here. Without Kathy here, I will be a little limited in my responses, but I will do my best. So let me pull up the first couple of questions. So if you're still in the chat, feel free to put them in Q&A and I will answer what I can. Anything we can't get to, I'll have Kathy jump on and we'll send you that answer directly. The first question was about Roth conversions. So switching from a traditional to a Roth IRA, the question is, can I convert just part of my IRA instead of the whole thing? The answer is yes. Likely you're not going to be doing the whole thing. So in that example, there was a $900,000 in that traditional IRA. You're converting over what portion you'd like. You don't have to do it all in 1 year. Most of the times, this will be a 5 or 6 year plan to convert whatever amount you want over. So if you're in that, let's say you're in the 10% bracket and you want to maximize that 12%, that's usually about $60,000 per year you can convert over and still stay under that 12% tax bracket. If you're in the 20, 22, that range, the levels are all different. So it should be customized to you. But if you're looking to do a large amount of conversions, make sure you're doing this at least 5+ years ahead of retirement age. If you're not, there's just not quite as much we can do, but we still want to do the planning and do what we can do. Just because you're later, maybe you're 62, 63, right before retirement, there's still benefit of this. The next question, what kind of work can my child do in the business? So that really depends on what your business is. We work with a lot of realtors, a lot of real estate investors, but also trades. So basically, if you've got an employee doing work, you can probably have your child do the same if they're age appropriate. Some common ones we see are, for example, marketing, doing social media management, answering phones, even some office type stuff, shredding paper, cleaning the office. There's a lot of tasks they can do. So maybe they won't earn $80,000 in a year, but it's not hard to justify, let's say, $10,000 for that year. And that $10,000 it's enough to invest that to maximize that Roth IRA and get those long-term benefits. The next question is along the same lines, how much can I reasonably pay my child without raising red flags? So there is no minimum, there's no maximum. There is no set rules for when the red flag would occur. I would say if you have a 3-year-old and you're paying him $90,000, that's probably going to be a red flag. But if it's reasonable, if it's necessary to your business, even if there's a red flag, as long as you have the substantiation and the documentation, it's going to be very clear. Here you go, IRS, it's legitimate. It's not a problem if you're doing it the correct way. Okay, next question is also around payroll for children. What happens if my child earns more than the standard deduction? So the standard deduction is that it's almost that freebie of your income. So in 2025, I believe it's $15,500. So they can earn up to that amount and pay 0 in taxes. If they earn above that, they just go into the 10% tax bracket. So if you yourself are in let's say 24% bracket and you're paying them and now they're in the 10, you're still getting a 14% tax savings. They will then pay the 10%, you're out to 24. So it's a win for you, but them in 10% is still not a bad thing. So it just means they pay some taxes and it's only on that difference above the standard deduction. And the last question I'm seeing here, I haven't seen any new ones come in. So let me just answer this last one. Is this better than a 529 plan? So that really is, honestly, I would discuss that with your financial planner. A lot of it comes down to the full picture. And this doesn't have to be an either or. You can do Roth IRA and 529. Me personally, I would probably lean towards the IRA over a 529 just because the tax benefits are so good and there's a lot of control of the funds, whereas 529 are much more restrictive. One, on what you can do with them, it has to be education based, but also on the investment side. There's only a certain number of assets you can invest into, whereas a Roth IRA is much more open-ended from an investment standpoint. So that one, make sure you take your full financial picture into account, but generally I would say Roth IRA over 529, but not in all cases. So talk to your tax advisor as well as your financial planner, because that's kind of a joint question there. So before we move on, I'll put up a slide here. If you have any questions, we would love to help you. Like I said, we're getting very close to that year end. So if you have any additional questions, you want to work with us one-on-one, we'd love to meet with you. Please call us as soon as possible because we are running out of consultation slots and we want to make sure we can get to you. If you're a new business looking to do business with us, we hold free discovery meetings. You can scan that QR code and you'll meet with me one-on-one. We'll go through your business, go through your books, your tax return, see if we're a good fit, see what services you need to not only stay compliant, but proactive in your business. And to wrap us up, thank you for joining us on this Tax Tuesday, going over year-end tax deductions. And hopefully we'll see you on, January 20th. Yep, January 20th at noon. And one last plug, if you're interested, feel free to register right here. And we already have the February, March, and April schedules published here. So I will be updating this with links today or sometime this week. So we'll come back and look at it and see which ones you would like to attend in January. But have a great day. It was good seeing you.